Deemed disposition on death. Deemed disposition happens on the date of death of the taxpayer, which means all the capital assets are considered to be sold at fair market value of the property. So there could be a capital gain or capital loss. Properties transferred to spouse or to a dependent child does not trigger these tax rules. Now, capital assets can be depreciable or non-depreciable. First of all, let's talk about depreciable property. Let's assume that John bought a piece of land for $150,000 in year 1991. John passed away today, and the fair market value of that piece of land is $450,000. So there is a capital gain of $300,000. 50% of the capital gain is taxable. Now we have to see who the property is transferred to. If the property is transferred to a spouse or to a dependent child, then there are no tax implications. Spouse or dependent child can take the property at adjusted cost base of $150,000. Now let's assume that John is transferring the property to his son Robert, who's 40 years old. So if he's transferring the property to his son, who's not a dependent child, we have to calculate capital gains tax on $150,000 on John's final tax return. His son Robert can take the property at adjusted cost base of $450,000. Now let's take example about depreciable property. Let's assume that John had also purchased a building for $200,000 again in year 1991. John passed away today, and the fair market value of the building is $400,000. So there's a capital gain of $200,000. 50% of the capital gain will be taxed, which is $100,000. And if the property is transferred again to his son, who's 40 years old, then we will calculate capital gains tax on John's final tax return. Now, in case of depreciable property, you always have to worry about UCC, which is undepreciated capital cost. And all the depreciable properties will have UCC. Let's assume that the UCC of the building is sitting at $150,000. And the property was purchased for $200,000. So there's a recapture of $50,000. Recapture is taxable in year of death on John's final tax return. So recapture will be 100% taxed compared to capital gains, which are only 50% taxed. Also note that in year of death, capital losses can be deducted against any other source of income. So if the deceased taxpayer didn't have any income in year of death, they can also be transferred 1 year back to be claimed against any other source of income when you're preparing final tax returns for the deceased taxpayer.